When I take a look at these charts and I see straight up, it's hard to believe that we're not going to see some kind of consolidation. Before the segment, we were talking about the big gaps. Do you think that AI will live up to everything that people think it will and sort of in a straight line higher?
Well, a few things to unpack from that. First of all, when you have a parabolic chart in anything, in any commodity, any stock, it means that there's either a mania or some intense pain. And I'm going to argue there's probably some of each here. And the pain may be more FOMO than shorts getting squeezed, like, let's say if you saw like lumber go up or something like that. But so there is that sort of psychic pain going on. And those tend to resolve very unpredictably. They tend to end very badly, but you never know when. And so it's a very tough tape to fight. You can't really get in the way of it. All you can do is maybe, if you're long, hold your nose, maybe buy some puts as a hedge, and hope they don't pay off. And that's really the only way to deal with it when you get into this. Can AI live up to the hype? Sure, the internet did, but did all the stocks live up to the hype?
Well, you've brought us a tremendous chart to talk about how it could, in fact, not live up to the hype, at least in a straight line higher. And what we're looking at here in this chart is the NASDAQ and the NASDAQ 100 versus the advancers decliners. So in yellow, we see that's in clear divergence to those indexes going higher. So it's on very few stocks and not the best foundation. Yeah,
this is an interesting one because the top line, the bright green one, sort of is NDX. You can see how much it's really outpacing the NASDAQ comp in white, which they usually move pretty closely together. This is one of the widest divergences we've seen, particularly of NDX outpacing the composite. But then we also see the yellow line being the advanced decline line, and it's not even coming close to confirming this. Interestingly, look back about 2 years ago, and we see pretty much the same thing. From sort of this period of time on, you saw the indices march higher, not being confirmed by the advanced declines, and then ultimately in November, NASDAQ topped out. In January, the S&P topped out, and down we tumbled. The problem is, again, this is one of these things, the divergences tend to be bad, but timing them is next to impossible.
Yeah, because the last time you said it took months to unfold. Well, let's bring the VIX and the VIXN, fold those volatility indexes into this conversation. They seem relatively subdued.
They are. I mean, I think people, these are very quantitatively driven markets with a few momentum-driven exceptions, as we know, and those tend to suppress volatility. It is a little unusual to have suppressed volatility at the same time you have rising interest rates. Usually lower interest rates depresses volatility, but markets seem relatively complacent right now. VIXN had gotten very low relative to VIX before this run-up. Now they're sort of getting back to a more normal spread, which is about, say VIXN tends to be about 6 points above VIX. But one of the things that's also interesting here is we're seeing that spread widen. Normally they both move in the same direction, just one moves faster than the other. In this case, we're actually seeing VIX tail off until just basically a few minutes ago, and VIXN tailing up, which means there's more demand both for hedges and for speculative calls. And so I think that divergence is another one that bears watching. But the problem, as I keep saying, with these divergences, I can't tell you when they pay off.